If you're thinking about buying a home in the UK, remortgaging, or investing in property, the mortgage process can feel confusing, especially with interest rates, affordability checks, and lender rules changing all the time. In this video, I'm going to walk you through exactly how the UK mortgage process works in 2025, step by step. I'll explain what lenders actually look at, what slows applications down, what a broker does behind the scenes, and the common mistakes that cost people time, money, or even the property they want. By the end of this, you'll understand the full journey from I want a mortgage to keys in hand, and you'll know what to prepare so you're not scrambling halfway through. Quick note before we start. This is general information, not personal financial advice. Everyone's circumstances are different, and mortgage eligibility depends on your income, credit profile, outgoings, and the lender's criteria at the time. First, let's get one thing straight. A mortgage is not just a loan secured on a property. The lender is lending against two things at the same time: the property and you. The property is their security, but you are the repayment plan. That's why a perfect property doesn't guarantee a mortgage, and why two people buying the same house can get totally different outcomes. Lenders assess risk, and they do it in a fairly predictable way if you know what to look for. Step 1 is affordability. This is the part most people misunderstand because they hear you can borrow 4.5 times your income and think that's the whole story. In reality, lenders start with income, but then they subtract commitments and apply stress tests. So they look at your basic income, whether you're employed, self-employed, or a director of a limited company, and then they check what else is leaving your account every month. That could be credit cards, car finance, loans, childcare, maintenance, regular transfers, even subscriptions. Then they stress test the mortgage payment at a higher interest rate to see if you could still afford it if rates rise. That's why someone on 60k with no debts might borrow more than someone on 70k with heavy commitments. It's not just income times a number, it's income minus real life. Step 2 is your credit profile. Lenders pull data from credit reference agencies to check how you manage credit. They're looking for missed payments, defaults, CCJs, high utilization, lots of recent credit applications, and general stability. A big one people miss is that it's not just bad marks that matter, it's behavior. If your credit is maxed out or you're applying for credit constantly, even if you've never missed a payment, some lenders will view that as higher risk. Another mistake is ignoring your bank statements. Even if your credit report is clean, your bank statements still show patterns. If you've got gambling transactions, lots of returned direct debits, or your account is constantly dipping into overdraft, some lenders will take that seriously. The bank statements tell a story about stability. Step 3 is your deposit and source of funds. The lender needs to know where your deposit comes from and that it's legitimate. If it's savings, great. If it's a gift from family, that's still fine in many cases, but it needs documenting. If it's from selling crypto, overseas money, or multiple transfers between accounts, it can get more complicated and it can slow things down. The solicitor also checks this for anti-money laundering rules, so the cleaner and clearer your deposit trail is, the smoother the whole process becomes. Step 4 is getting an agreement in principle, often called an AIP or DIP. This is basically the lender saying, based on what you've told us and the checks we've done so far, we'd consider lending up to this amount. An AIP isn't a guaranteed offer, but it's important because estate agents often want to see it before they take a property off the market. Here's the key: an AIP is only as good as the information that went into it. If someone has guessed their income, not disclosed debts, or not been honest about credit, the AIP can be meaningless. The goal is not just to get any AIP, the goal is to get an AIP that actually turns into a mortgage offer when the full checks happen. Step 5 is choosing the right mortgage product. This is where the internet often makes it worse, because people see a low headline rate and assume it's the best deal. But the best deal depends on your plan. Are you likely to move within 2 years? Are you fixing for stability? Do you need flexibility to overpay? Are you buying to live in it or as a buy-to-let? Do you need to use a limited company SPV for the rental? All of that changes the lender pool and the product choice, and fees matter. A slightly higher rate with no fee can sometimes be cheaper overall than a headline low rate with a chunky product fee, especially on smaller loan sizes. So you always want to look at the overall cost, not just the rate. Step 6 is submitting the full mortgage application. This is where the real process begins. The lender will request documents and they will verify everything. For employed applicants, that usually means payslips and bank statements, sometimes a P60. For self-employed applicants, it might mean SA302s and tax year overviews or full accounts. For limited company directors, it could include accounts, salary, dividend breakdown, and sometimes calculations of retained profit, depending on the lender. This is also where people lose time, not because the lender is slow, but because documents are missing, inconsistent, or unclear. A classic example: bank statements that don't show the full name, or screenshots instead of PDFs, or deposits that aren't explained. Another common one, outgoings that contradict what was declared. If you said you spend $200 a month on living costs, but your statements show $900 in regular payments, the underwriter will question it. Lenders hate surprises. Your job is to remove surprises. Step 7 is valuation. Once the lender has your application, they usually instruct a valuation of the property. This is not the same as a full survey. A valuation is primarily for the lender. They want to confirm the property is worth what you're paying and that it's acceptable security. Sometimes this is automated, sometimes a valuer visits. If the valuation comes back at the purchase price, great. If it comes back lower, that's called a down valuation, and it can change your loan to value and your product options, or force you to renegotiate with the seller or add more deposit. Valuations can also flag property issues like short leases, non-standard construction, certain cladding risks, or anything that makes the property harder to sell. If the lender isn't comfortable, they can decline even if you personally are strong, so property choice matters. Step 8 is underwriting the part nobody sees on YouTube. Underwriting is the lender's deep dive. They assess your documents, your income, your credit, your outgoings, the property, and the overall risk. They might ask additional questions called queries. This is normal. The speed depends on how clean the case is and how fast everyone replies. If you want your mortgage to fly through, you need 3 things: consistent documents, clear explanations, and fast responses. Most delays happen because people disappear for 3 days when the lender asks a question, or because they send the wrong files again and again. Step 9 is conveyancing the solicitor side. While the lender is underwriting, your solicitor is doing searches, checking the title, reviewing the contract pack, raising inquiries, and making sure the property is legally sound. This includes local authority searches, water and drainage, environmental issues, planning, rights of way, and any restrictions on the title. The solicitor also needs to verify your identity and source of funds. A big reality check here. Even if your mortgage is approved, you don't complete until the legal work is done. If there are title problems, lease issues, or unresolved inquiries, it can delay exchange and completion. So a mortgage offer doesn't mean we're done. It means one major piece is in place. Step 10 is the mortgage offer. Once underwriting is satisfied and the valuation is acceptable, the lender issues a formal mortgage offer. This is the document that confirms the loan amount, the rate, the term, the monthly payment, the conditions, and how long the offer is valid for. Your solicitor receives it too. At this stage, you're close, but there's still a final stretch. Step 11 is exchange of contracts. Exchange is when the purchase becomes legally binding. You usually pay the deposit at exchange, and a completion date is agreed. After exchange, pulling out is expensive because you can lose your deposit and face legal consequences. So you only exchange when your solicitor is happy, your mortgage offer is in place, and you're ready to complete. Step 12 is completion. The day the funds move, ownership transfers, and you get the keys. The lender releases mortgage funds to your solicitor, the solicitor pays the seller's solicitor, and the estate agent releases the keys. That's the end of the process, but it's also the start of the real part, paying the mortgage monthly and managing it properly. Now let me give you a simple example so you can see how the steps connect. Imagine you're buying a $350,000 property with a 10% deposit, so you need a $315,000 mortgage. You get an agreement in principle based on your income and credit. You have an offer accepted, you apply. The lender checks your bank statements and sees you've got a car payment of $420 a month and a credit card that's near its limit. That reduces affordability, and the lender asks for an explanation and possibly evidence the credit card is being paid down. At the same time, the valuation comes back at $340,000, not $350,000. That changes your loan to value, meaning you might need a bigger deposit or to negotiate the price down. None of this means you can't get a mortgage. It just means the process is real and the details matter. So, what are the biggest mistakes people make? 1. They start house hunting before affordability is clear and then fall in love with a property they can't actually secure. 2. They ignore credit until the last minute. 3. They don't prepare documents properly and end up in a back and forth with the lender. 4. They focus only on interest rate and ignore fees, early repayment charges, and flexibility. 5. They underestimate how long solicitors and searches can take. If you want to avoid pain, your goal is to be organised and consistent. Treat the mortgage process like a project. Clear inputs, fast responses, no surprises. Finally, what does a broker actually do in this process? A decent broker isn't just finding a rate. They're matching you to the right lender, packaging the case so it gets approved, anticipating problems before underwriting finds them, and keeping the process moving with the lender and the solicitor. They also help you understand product features, the risks of different choices, and what you can do to improve your position. And if your case is more complex, self-employed, limited company income, adverse credit, unusual property, that lender knowledge can make the difference between approval and rejection. If you found this helpful, subscribe and I'll do follow-up videos that go deeper into specific situations, how much you can really borrow, how lenders assess self-employed income, first-time buyer mistakes, remortgaging timing, and buy-to-let basics. And if you want support with your own situation, you can reach out through the links on the channel. Thanks for watching, and I'll see you in the next one.